Today, we're diving into one of the most closely watched leading economic indicators, the Purchasing Managers' Index, or PMI, with its predictive power over commodities and energy prices. Before we get started though, don't forget to hit the subscribe button and give this video a thumbs up if you like what you see. When we talk about economic indicators, few are as important as the PMI. But what exactly is the PMI and why should investors pay close attention to it? Let's unpack this. The PMI is a survey-based indicator that tracks the health of the manufacturing sector. Every month, it surveys tens of thousands of companies in 40 countries, covering 95% of the world's manufacturing output. PMI components include new orders, production, employment, supplier deliveries, and inventories. A reading above 50 indicates expansion. Below 50 indicates contraction. Simple yet powerful. But here's where it gets interesting. The PMI doesn't just tell us about the present. It helps predict future market trends. When the global manufacturing PMI crosses above its 3-month moving average, it often signals a rise in demand for manufacturing inputs like oil and copper. This phenomenon, known as a golden cross, has historically correlated with rising prices for these commodities in the months that follow. Conversely, when the PMI falls below its 3-month moving average, or what we call a death cross, it signals a potential drop in demand. This can lead to lower prices for commodities. By keeping an eye on these PMI trends, investors can anticipate shifts in commodity markets before they're reflected in actual price movements. It's a vital tool for making informed investment decisions in this volatile category of commodities and energy. For more on the commodity space and how to utilize investment tools like the PMI, visit our website at usfunds.com. Happy investing!